Hi, welcome back to Trade with Conviction. I'm Felipe Sherman, and today we're Thursday, February 19th, and we're kicking off with our geopolitical corner to set the table. There is a lot of noise out there this week, so let's filter through the fluff and look at the global power dynamics and how they're actually moving the barrel. I would say there are four main drivers setting the board this week. Obviously, the first one being the Iran ultimatum. Over the last week, the US administration completely changed the diplomatic playbook regarding Iran. They issued a public ultimatum threatening action over the nuclear framework. And crucially, they officially advised commercial shipping to steer away or clear from Iranian waters in the Strait of Hormuz. The US has deployed a second aircraft carrier, and Iran temporarily closed parts of the Hormuz for naval drills. And the market is awash with all the talk about all kinds of military, apparently Air Force assets making their way across Europe into the Middle East. And according to the Wall Street Journal, the US gathers the most air power in the Middle East since 2003 Iraq invasion. Obviously, that is driving the market much higher. I think we've seen fat price going up all the way to 73 at some point, now roughly around 70. Not surprisingly, I would say. The second main theme of the week has obviously been the Munich Security Council. Over the weekend, global leaders gathered at the Munich Security Conference, and the official theme of this year was literally under destruction. And that tells you everything you need to know about the mood in the room, I guess. Merz was the first one to speak and was unusually frank towards Trump. He pointedly suggested Europe is de-risking vis-a-vis great powers, obviously, i.e., US. And Merz's speak confirms that tendency that has been increasing over the last weeks, that European states are responding far more firmly to the US isolationism and American disinterest towards Europe. Oddly enough, Marco Rubio managed to get a standing ovation. I guess that's more a counterbalance to what happened last year with Vance. But he still delivered a very transactional, pay-to-play message with regards to NATO and security umbrellas, and also reinforced this whole message that the world order post Second World War is finished. This reinforced more talk of a European nuclear umbrella expanding and not being reliant on the US. So I guess it's more boldness from Europe, but as we always say, Europe talks a lot, but let's see what they do about it. More interestingly, at the European Security Conference, the British Defence Secretary, John Healey, met with counterparts from the Baltic and Nordic nations to discuss seizing oil tankers linked to Russian shadow fleet, prompting a warning from Russia, which may use its navy to escort vessels. Now, it's interesting because the meeting underscored a growing willingness among allied nations to squeeze revenue from Russian President Vladimir Putin's war in Ukraine. And Europe has suggested getting rid of the Russian price cap and replacing it with a marine service ban, which completely cut off the 20% Russian flows being serviced under the price cap by legit vessels. Now, obviously, that could make life much more difficult for the dark fleet, already stretched, and might put pressure on the legit vessels, the Afras and the Suez market, as Greek and Cypriot owners stop playing the legit Russian trade. So, something to keep an eye on, and that's directly impacting our day to day market. Obviously, we cannot talk about geopolitics without talking about Ukraine and the Geneva standoff. So, there was a highly anticipated US brokered trilateral peace talks between Ukraine, Russia, and the US. And they concluded in Geneva and obviously, unsurprisingly, I would say, ended without a breakthrough. Despite this intense pressure from Washington to strike a fast deal, the two sides are completely deadlocked. President Zelensky used this time in Munich to demand a 20-year ironclad security guarantee, which Russia responded by literally bombing the negotiating table. On the eve of the talks, Russia launched a massive wave of 400 drones and missiles specifically targeting energy grid. At the same time, we saw 3 drone attacks on Russian refineries over the last week, a risk we discussed last week on our live pod, as well as an attack on the Black Sea port of Taman, and last month's attack on the Dzurba pipeline. Obviously, this just underscores the fragility of the energy and oil infrastructure with what you would call cheap weaponry, cheap drones, and that sort of sets the tone for constant bid level on a risk premium basis for oil. Now, that's the geopolitical corner. That's basically what we've seen this week and how it's impacting our market. But let's move on to what we know best, which is oil trading and oil opportunities. So, with me today, I have Neil, Jorge, and Phil. Hey, guys, how are you?
Morning. Good, thanks.
Good to see you again since last week. It was fun to make this live podcast, followed by our drinks. Something that we'll keep on doing over the next events. Guys, let's move on to gasoline or light ends, if you want. Jorge, what can you tell us about what's going on in the gasoline market and maybe naphtha as well?
Yeah, I'm gonna start with NAFTA. It's more driven by geopolitics. So we are seeing a strong correlation between flat price Brent movement and East West. So we were talking during the last week that East West was trading at historical highs. It has added $3 or $4 per metric ton in the last sessions. So highly correlated with the Brent trend. The more risk that we will see in Ormuz is going to be translated into a higher East West. So I think it's the indicator that has been more bullish from the whole barrel during the last 4 months. If you see the chart for East West, previous historical seasonal high levels are behind $10 per metric ton, behind the current levels. That give us a measure of the strength in the East West for naphtha. Then to finish with naphtha moving into gasoline, we have another strong headline that is impacting the market. The market has been driven also by the bad weather in the Mediterranean Sea. So we have two very important export regions that are going under constraints or tensions. We have talked about Middle East, and the other one is Med, a key exporting hub to Northwest Europe and to Asia. And the bad weather during the last 2 weeks have made almost impossible to load in almost any berth. So we have seen this constraint in the supply, and this obviously has been translated into a higher physical premiums in Northwest Europe and also into a higher time spreads in the European market. This is now gone. We are seeing loading not in the normal levels, but the market is starting to come back to a normal standard. So this is obviously bearish for the Northwest Europe naphtha, and we are seeing it on decreasing physical premiums and also on the paper side. And now moving into gasoline, I think the main headline we have it from Dangote. A lot of uncertainty, but we have seen news about the potential delay or if it was coming back on time. It looks like it's working properly right now. And overall, it has translated a lot of volatility into the European market. But if we look at the last 2 weeks, it has been mainly supportive. We are seeing higher EVO time spreads compared to 2 weeks ago for February, March, and for March, April.
Sorry, just you said obviously it looks like that is back up and running. I think the latest on the rumor mill is that there have been some issues on startup. So that doesn't mean that it won't come back running full pelt, but maybe some of the latest bullish uptick that we've had in the last couple of days has come from these rumor mills of some issues on the startup there.
Surprise,
Yeah.
surprise.
Yeah, there is always a last update on Dangote pointing on the opposite direction.
Can't
But
wait
yeah, I
for
think
3
it
days
gives
ahead.
more. Yeah, I think it gives even support to the European market into the Evo time spreads. And moving out of Europe, looking at the time spreads, it has been a completely different story in Asia and in the US. To give two measures, East West is trading at historical seasonal lows for March contract, and arbs time spreads are also trading at historical seasonal lows. And we are seeing contango in the Singapore and 92 market. So really bearish movements in the US and in Asia, and Europe a little bit supportive. And some drivers for these numbers. If we look at the stocks, we are seeing very high stocks for light ends in Singapore and in the US as well. Three especially, also path one are average. The only stocks that are below the average are in path five. And we can move to the pricing. How these headlines has been translating into pricing movements. We have already summarized it a little bit, but the naphtha market is trading lower on the physical and on the paper. Singapore 92 is on contango right now. West gas March for March is at the lowest point in 10 years, and our BOP spread are also very weak. We can see a massive change on the arbitrage based on these pricing movements. First, starting with naphtha, we are seeing still the ARB open from Med into Northwest Europe, but in the medium term is starting to point to the east. Right now, Northwest Europe has lost its main supplier for a couple of weeks, that they can get the product. They are raising the premium to get it quickly. But the rally in East West, it's if you look at the arbitrage for the forward months, is pointing to the eastern outlets. And in gasoline, we are seeing for the first time in some months, if I'm not wrong, the opportunities for the DAR, not for blenders, but for refiners, March deliveries, April deliveries. So it looks a little bit better, the margin on there. It's good, would be good to keep an eye on this. On the other side, blend margins in Europe are also strengthening. So we are seeing not fully open, but E5 and E10 margins are improving. This is bearish for the European market because it will mean that the best option could be to blend locally rather than exporting the product. Yeah, and overall, Atlantic Basin outlets on gasoline right now are quite disputed between Houston and Erie.
Yeah, it's interesting that obviously when you talk about the market in the US being at historical contango, similarly in Singapore, but at the same time the arbs are open from Europe into the US. It seems surprising, but it's
Yeah,
also a function of contango. Actually, it's
yeah,
just a matter of where is the where should the oil be on a geographical basis, but also on a temporary basis. And basically, that's pointing right now with the contango you have in the US that where you want to be placing that oil is in deferred, let's say Q2 US. That's the best place to point the oil right now. So it's that basically explain why you can have a simultaneous bearish US and at the same time open arb.
yeah, yeah. I think the most interesting part of the gasoline market in the Atlantic Basin at the moment, together with the headlines on Dangote.
Yeah, and again, particularly for longer routes like from Asia to West Africa or to US, Mexico, those are things that will continue being open as long as that contango remains where it is.
Yeah, yeah, exactly.
Okay, so what are your recommendations or trade ideas for this week then?
Yeah. First, we talk about a long pivot time spreads for March April. Right now, we should suggest to close this position. The first time we say it has increased $4-5 per metric ton, but I think the fundamentals behind Dangote are now gone. So I think it would be too risky to keep this position for the March April.
Okay, understood. And obviously, we had this idea that when you looked at March, April on a summer to summer grade, the contango was even higher than the Feb March or any other contango that you had out there. And now it's less the case. And Dangote is back. But what about Q2? Because obviously, we see the massive contango in Asia, historical high. We see the US also with historical contangos. But yet, we see a slight backwardation or a fairly flat market in Q2 in Europe. Is that a short position to have? What do you guys think?
Yeah, I think the short there is also risky, so I will move to a flat view, mainly because we've talked about the ARB improving from Europe into path one for April and for May deliveries, more outlets in the Atlantic Basin for the European market. So that would be the main fundamentals behind it.
Any ideas on that?
Yeah, I'm sticking to my short Q2, especially April May position. We'll talk about it in the distillates section as well. But I think now a good opportunity that we have a bit of a surprise in terms of how much volume is being stored and how much volume will remain in the market being produced through March and April. East-West being at these kind of levels takes out any potential outlets to the east as well. Dangote is coming back. I think we just might surprise to the downside from here for April at least.
Okay. Well, actually, let's move on to distillates. In that case, with James having a well-deserved break this week, Phil, I'm hoping you can step in and tell us a little bit about the headlines that are driving the distillate market this week.
Sure. So you mentioned already in the beginning the three recent drone attacks on Russian refineries of the last week. It looks as though that energy ceasefire that was supposedly there between Ukraine and Russia through the depths of winter is over. So that signals at least an ongoing potential for more attacks on refineries, on export infrastructure in Russia. Elsewhere, the headlines seem to be suggesting that turnarounds might be relatively light, both in the Gulf Coast and in Europe. Heavier in the east of Suez still, but relatively light in the west. We've got Dangote back potentially now. It's obviously, we talk about it mostly as a gasoline or an LPG trade, but it's a big jet producer as well. And we should be getting towards the end of a seasonal kind of heating demand upside for Europe. So milder weather ahead, we get back to maybe some underlying commercial manufacturing demand. Maybe there's some potential for downside surprises from there.
Okay, so a bit of a short-term bullish momentum based on headlines, but broadly sounding a bit bearish when it comes to balances. So how are the prices reacting?
Yeah, overall, we've had a bit of a recovery from where we were in early February. Obviously, March, ice gas oil went to expiry almost flat, so I think about +1. But we've not had a particularly exceptional recovery. March, April is looking obviously stronger than that, but we're still at the lower end of the recent seasonal range. We're still in kind of single digits at least. So on gas oil, we've had a bit of a recovery, but not a huge one. And jet diffs actually are something which are probably a bigger story. Both European jet diffs and the regrade in the east have been ticking up, and actually the European jet diffs have really moved to recent record highs, at least in the last few days.
Okay, and looking forward, what are we seeing in the platform at these kind of levels?
Sure. So the slight recovery that we've had in Europe has not been enough to overcome movements on HOGO and East-West. So both of those, alongside some freight movements as well, have moved to shut all of the arbs on diesel into Europe. Those swing barrels that we talk about out of the Middle East are all pointing east for now, with some small exceptions to cargoes that maybe can move through the Suez because there's some tightness in the mid. So there's some arbs open into the mid, but largely we're pointing east for those swing barrels. And the Gulf Coast arbs are closed on high freight in particular. So from an arbs perspective, it's looking a bit more supportive from a European diesel perspective. And if we're looking at the east of Suez, I mentioned it looks as though that we've got some decently heavy turnarounds coming. We're seeing that already in cash diffs in both the Middle East, but also the Far East. In the east of Suez, the cash diffs on diesel at least have been ticking higher, so potentially slightly counter to a longer balanced narrative in the east as we enter turnarounds, or the market is starting to look ahead to a potentially heavier turnaround season in the east. On jet, we have a little bit of a different picture, thanks to the very strong Northwest Europe jet diff that we now have and a relatively strong jet market in the US. Those swing arbs are still pulling into the west of Suez rather than to the east. And within the Atlantic basin, actually, the US Atlantic coast, so Pad 1, is the better outlet still, the better netbacks for those swing barrels. So it looks as though that Northwest Europe jet diff, which has been moving higher, is maybe not quite high enough to secure those barrels out of the Middle East, but we'll see with Dangote coming back whether or not they're really needed in Europe. Finally, on the arbs at least, US West Coast arb margins, those have been at historic highs over the last few months. They've been coming off quite significantly. They reached almost parity if we're looking at Korea, Japan, arbs into the West Coast, and that spurred a bit of a recovery in cash diffs in Pad 5. So it looks as though that arb is still needed, but it's unlikely to return to the heights that it did a couple of months ago.
Okay, so I'm going to push you for a trade idea here, if you don't mind. Are we sticking with this feeling from last week about deferred ice gas oil spreads looking like a buy from here, or you have a different opinion?
Yeah, I think there's good arguments to be made on both sides, but I think on the balance of risk, I would still be long deferred ice gas oil spreads. So we're talking kind of obviously from here, maybe March, April, and April, May potentially. We are entering turnaround season, whether or not that ends up being heavier than normal, but at least it should be relatively supportive. But more importantly, we are likely to be cutting off the supply from the Middle East or from India. So those arbs are now pointing east, and maybe there's less availability anyway from that region. So with these closed arbs into Rotterdam, we should be on balance relatively bullish from there. Spreads have recovered a little bit, but I think there's room to the upside still, especially if we look at recent years' seasonality and we think about potential further attacks on Russian infrastructure. And if we look at kind of the wider Atlantic basin, Pad 1 and 2 stocks are still low. So we can assume some of that Pad 3 length, it doesn't have to be exported internationally. It can maybe stay domestically and therefore help the ice gas oil market to be relatively supported. So I think there's a few decent kind of arguments on the bull side, at least there.
Anyone wants to take the bear side?
Yeah, I'll go for at least a couple of bear points. So the one is I'm hearing from people that outside of India, maintenance schedules are pretty light at the moment. So you can see it in US runs, for example. We're still miles up year on year on the run basis. And that's an interesting point as well, because I was reading, for example, I think it was Valero's quarterly earnings report for Q4, and they were making mention of the fact that cold weather had allowed them to run very, very strong. And it feels like weather plus the lack of real maintenance on the books plus lack of unplanned outages, that has all contributed to really high run rates in the US. The European maintenance will be relatively weak in the spring as well, which leaves just India, which is the heavy one just now. There's the kind of fear that okay margins plus relatively limited maintenance actually can move the dial on the distillate balance alongside things like heavier slates. We know that there's more heavy crude in the market that tends to get more resid that you can upgrade, and yeah, that's one of the themes that we had in our live podcast last week, which is watch out for heavier slates and their impact on the relative yields. So I think that's the sort of main bear argument for diesel at the moment.
Fair enough. Should we move on to crude? Neil, what can you tell us about the crude market, maybe starting with news headlines?
Yeah, well, other than the obvious one, which is Iran. So everything I say needs to have that caveat. Obviously, we've got no idea what's going to happen maybe tonight or this weekend. So all things can change. But in terms of the headlines, the more interesting stuff includes the first hint from OPEC that something might change on their supply. And I was quite surprised because we have this feeling that the physical market is relatively weak. And OPEC came out and there was headlines that said some countries are considering hiking again in April, which actually took me a bit off guard. They have a meeting on the 1st of March. I think it's a bit premature, but on the other hand, maybe they know something that we don't on Iran. Maybe it's that kind of thing. But the other sort of read on that is that they're actually just testing the market. Can the market take that kind of headline just now? And obviously it can, particularly when Iran is so tense. But we'll find out on the 1st of March what they do. The other news bits relate to just how the global flows are changing, right? All these kind of bits and bobs. The first being Saudi term volumes. So there was a big jump in the allocations that Saudi gives to China. So basically, term flows from Saudi to China are up a lot for March on month and year basis. And I'm hearing almost in real time from June, who's also heard that there's a similar kind of picture going into India in the coming weeks as well from Saudi. So there's this big push from the Saudis to get term barrels out to market, which all else equal is bearish for the spot market, right? And the other thing is just how Venezuelan and Russian barrels are now shifting. So the big story, of course, is Indian imports are changing. They're reducing their exposure to Russian. They're taking more Venezuelan barrels. So now the total purchases of Venezuelan into India is approaching sort of 200 KBD mark, which is not nothing. And it's probably one of the reasons that Murban has been in high demand. There's continual talk about blending this really super heavy stuff with Murban, and that's partly contributing to the rally in Murban, which, if we recall, over the last 1-2 weeks, that was one of our calls, right? The spot AG diffs are going to rise.
Just to interrupt, I mean, I think no one was expecting the whole talk about Venezuela is that on a short term, don't expect much, and 200,000 barrels going to India is not something I think anyone had the bingo card, if you want.
No, not a month or two ago. It was sort of first we saw one cargo being purchased, and then gradually there's just more and more. So it seems like a trickle that's slowly turning into a stream, which makes sense. It's very nice crude, right? And it's partly the reason, as I've said before, that the initial assumption was all Venezuelan would just go to the US Gulf. And that's partly why TI is so weak, or the US market is so weak. But we see more and more it's going to India. I think there's even a cargo going to China now, and it's free to trade on the free market, right? There's essentially no sanction on it anymore. And the other angle of that is Russian, right? And it seems like more Russian is now going to China. Actually, Russian exports are rising, and that is being attributed to a few things. I don't know if the timing works, but there's been, as we said, 3 attacks on refineries over the last 2 weeks. And in theory, that will tend to raise Russian crude exports. And there was also this attack on the Druzhba pipeline, which is worth another 150 KBD. It's actually quite big. And it's supplying the Slovakian and Hungarian refineries on the southern leg of the Druzhba pipeline still. So all this means there's a chance that Russian exports can actually rise. That's a different story to Russian production. Everyone's talking about Russian production in January. I think we should just ignore that. It's more about what's happening to exports. And the final thing on that is China is taking more and more seaborne Russian crude. So it seems like so far the rejection of Russian in India is being soaked up more and more by China, which makes perfect sense. We had doubts about whether it could do everything, but so far it's almost a perfect replacement or rewiring. So we have to be less worried about the buildup of Russian oil and water for now.
What about pricing then?
On pricing, that's the bit where it's tricky this week, obviously, because as we've just said, pricing is just driven by Iran. Yeah, flat prices now, as we're talking, at $71. The EFS is still very elevated. The EFS is $2. That makes things tough for the Arb East. And the TI Brent is also extremely wide. I mean, we're approaching expiry, but I'm looking at the April TI Brent future. We're now minus $5.30. So it's really, really wide. So it's all hyper extended by the Iran story. And the last thing on that is most physical crude diffs are still down year on year by a long, long way. And the ones that aren't is basically the North Sea. And we know that in the North Sea, a few times a year, we get to this stage where we know that there's kind of window games going on. We know that this thing will correct. We just don't know on the timing. But what we shouldn't do is say, oh, this is evidence of a tight physical market. So I think it's safe to say the North Sea is not that tight.
Exactly. I mean, you obviously have views of the market that do not correspond with the physical reality. At the end of the day, the physical reality will always impose itself. So it's just a matter of time. And the more it is bid now in a sort of ample supply, the more the correction will be stronger. So it's something to keep in mind. And I generally, in terms of timing, unless there is a trigger event that changes the supply and demand, then you will not be surprised to have a change in dynamics in March.
Yeah, I'm just recalling numerous times last year where I said, "Oh, definitely next week is going to correct," and it never did. And then 3 weeks later,
Yeah,
it did, and I basically repeated myself for 3 weeks. So I'm not going to fall into that
for
trap.
sure. For sure. Yeah, exactly. Yeah.
On the arbs, I mean, the signals they're sort of tweaking a little bit. So it's still for most, let's say, North Sea WAF crude, it cannot arb east, mostly because of the combination of freight, physical premiums, EFS. The thing that is changing a little bit is on the strength of Murban. Right, so there has been this rally, particularly in Murban, but the spot AG diffs, as we actually looked for. I don't know if we could predict this level, but we looked for a rally and it happened. And we're now in a situation where Murban still looks really cheap into India. And that's important because they're looking for replacement crude and also for blending. And it's pretty short haul to India, so the freight works out. But in the Far East, Murban now looks too expensive. So for the first time in quite some time, WTI is landing cheaper than Murban into Far East ports. And so is something like CPC. CPC is this big high volume crude that can arb east. The supply is returning. FOB diffs have cooled a lot because supply is back. So TI and CPC are now landing cheaper than Murban on and off over the week. So from that perspective, for me, that's one of the reasons that the rally in the spot AG probably hits a ceiling soon. Unless, and that's the big Iran happens, and all bets are basically off. On the other hand, if there's a big risk off event, the arbs are going to massively change as well, because you probably see the EFS collapse. And then we have to basically reassess altogether next week. Happy days. So my main trade call, which the only one I want to do this week, is to say, as things stand, it seems like the spot diff rally in the AG should now hit the ceiling, and that's basis the arbs. The other thing about this, as we've talked about already, is that there's big maintenance in India in April. It's going to be close to 1 million barrels per day. So their natural need for these replacements crude is going to hit a ceiling. And the other thing is there's much more term crude being pumped into Asia, and we've got this risk now that OPEC are going to come out and say, you know what, I think we'll bring even more crude back to market in April. So those are the main bear cases for me. The main bull case is obviously if Iran happens, all bets are off.
Yeah, no, that's not something you can make a trade call on, or that's a punt, not a trade call. Okay, I think this wraps it up for us this week. Thank you very much, guys. Good talking to you, and we'll see you guys next week.
See you later. Thanks.
Thanks.